Imagine having, a bit of an edge in understanding these complex financial markets. What if you could kind of sense these shifts, maybe even spot hidden opportunities before everyone else catches on? Well, today we're doing a deep dive into something called short interest. Now, it might sound a bit technical up front, but honestly, it's a really powerful tool. It helps gauge market sentiment, understand risk, and we're basically going to unpack it for you. Our mission, keep it simple. We want you to quickly get why it's important, how the pros use it, without getting bogged down.
Yeah, I think the keep it simple approach is key here
Hmm.
because short interest, while it sounds complex, the basic idea isn't really that complicated. At its heart, short interest is just the total number of shares investors have sold short, but haven't bought back yet. They haven't covered their position, as they say.
Right. Covering means closing out that short bet. And just to recap, selling short, for anyone needing a quick refresher, it's the opposite of buying low, selling high. You borrow shares, sell them, hoping the price drops. Then you buy them back cheaper, return them, and hopefully make a profit on the difference. It's betting on a decline.
Exactly. A fundamental concept. And the amount of this short selling, the short interest, gets reported in a few main ways that you'll see. The simplest is just a raw number, like 50 million shares of company XYZ are currently shorted. Straightforward.
Okay, a big number, but 50 million shares. Is that a lot? I guess
Yeah.
it depends on the company, right?
Precisely, which is why the second way is often more useful. Short interest as a percentage of the stock's float.
Ah, the float. That's the shares actually available for trading, yeah, not the ones locked up by insiders.
Correct. So if you hear 25% of the float is short, that gives you much better context. It tells you how significant that bearish bet is relative to the shares people can actually buy and sell easily. 25% is, well, quite a chunk.
That makes more sense. It's about proportion.
And the third key metric is days to cover, or DTC. You calculate this by taking the total short interest, that raw number of shares, and dividing it by the stock's average daily trading volume. How many shares typically trade hands each day?
Okay, so short shares divided by average daily volume. What does that tell you?
It gives you a theoretical time frame. Like, if trading continued at its average pace, how many days would it take for all the short sellers to buy back their shares?
Ah, I see. So a longer days to cover means it would take them longer to get out of their bets.
Exactly. And that's often seen as a warning sign. A higher DTC suggests it could be harder for shorts to exit quickly if things turn against them, which can amplify volatility. It's definitely something pros watch closely.
A potential bottleneck. Okay, so that covers the what and the how it's measured. But let's get to the core of it. Why is this single metric, short interest, so important? Why do traders pay such close attention?
Well, the first big reason, and maybe the most obvious one, is it's a fantastic gauge of market sentiment. Just really direct. When you see high short interest in a stock, it's a clear signal. It tells you a significant number of market participants are bearish. They think the price is going down.
Simple enough. Lots of shorts, lots of pessimism.
Pretty much. It's the market voting with its money, essentially, on the downside.
So conversely then, if short interest is really low, does it automatically mean everyone's optimistic? Or is it maybe just apathy? Like no strong feelings either way?
That's a really good point. It's not always a perfect mirror image. Low short interest generally means there isn't a strong, active consensus betting against the stock. So less bearish pressure. It could imply stability, maybe some quiet confidence, or maybe just a lack of conviction needed to make that risky short bet. It definitely means less perceived downside risk from that angle.
Okay, context matters. Now, here's the part I find fascinating, where high short interest can actually mean something else entirely. You mentioned volatility, and this leads to the idea of a short squeeze, right?
Yes, exactly. This is where things get really interesting and sometimes explosive. A short squeeze happens when a stock with a lot of short interest unexpectedly starts to go up.
Which is the opposite of what the shorts want.
The absolute opposite. So as the price rises, their losses start mounting. Pretty soon they might hit their pain threshold or get margin calls, and they're forced to buy back the shares to cut their losses.
But wait, if they're buying back shares, that adds buying pressure, doesn't it?
Precisely. You get this rush of forced buying from the short sellers, all trying to cover their positions. This sudden surge in demand pushes the stock price up even faster.
Which forces more short sellers to cover.
And you get this powerful feedback loop. A rapid, often sharp rally fueled by the shorts themselves scrambling to get out. It can be quite dramatic.
And I think everyone remembers the big example of this GameStop, GME, back in 2021. That was like the ultimate short squeeze, wasn't it?
Oh, absolutely, a textbook case study. Extremely high short interest met a massive wave of buying, largely from retail investors, and the result was, well, historic. It really put short squeezes on the map for a lot of people.
Showed the sheer power of that dynamic. But then there's this other angle, almost a contrarian view you mentioned. Some pros see high short interest and think bullish. That seems counterintuitive.
It does at first glance, but there's a certain logic to it. Think about it. If, say, 40% of a stock's float is already short, that means a huge chunk of the market has already placed its bearish bet.
Okay.
So the contrarian argument goes, maybe all the bad news, all the negativity is already reflected in the price. It's been priced in.
Meaning there might not be much room left for it to fall further because everyone who wanted to bet against it already has.
Exactly. The potential downside might be limited. And if that's the case, any positive surprise good earnings, unexpected news could have an outsized impact to the upside.
Because all those shorts would be caught off guard and forced to cover, fueling that squeeze dynamic we just talked about.
Precisely. It's looking for situations where the pessimism might be overdone, creating an opportunity if the tide turns even slightly. It's a riskier play, requires careful analysis, but some traders specialize in finding these spots.
Okay, that makes sense. It's about potential energy, in a way.
Yeah.
So, let's talk practical application. How do the different types of professional traders actually use this information day to day? Let's start with the big players, like hedge funds.
Right. For hedge funds and large institutions, short interest is a core part of their toolkit. They often use short selling as a strategic component, shorting companies they believe are genuinely overvalued, or maybe shorting an entire sector they think is weak, as a hedge or a directional bet.
So they are actively looking for short opportunities based on fundamentals.
Often, yes.
Yeah.
But crucially, they also use short interest data for risk management,
Yeah.
specifically to avoid crowded trades.
Crowded trades, meaning too many people are already making the same bet.
Exactly. If a hedge fund is thinking about shorting stock A, but they look and see that, 35% of the float is already short and the days to cover is high, they might back off.
Why? Because the risk of getting caught in a squeeze is too high.
Precisely. They don't want to be part of that potential stampede if things go wrong. Being one of the last ones into a very crowded short can be incredibly dangerous. They prefer situations where their thesis is perhaps less obvious, or where the exit door isn't quite so narrow.
Got it. Avoiding the herd, especially when the herd is betting downside. What about, say, swing traders or options traders? They operate on different time frames.
Yeah, their approach is often quite different. Swing traders who hold positions for days or weeks, and options traders often actively seek out stocks with high short interest. But there's a key difference. They typically look for high short interest combined with a potential bullish catalyst.
Ah, the trigger. So high short interest plus what kind of catalyst?
Could be anything positive. A surprisingly good earnings report coming up, a new product announcement, a positive regulatory ruling, maybe a big analyst upgrade. Something that could potentially shift the narrative and spook the shorts.
So they see the high short interest as fuel for a potential fire and the catalyst as the match.
That's a great analogy.
Yeah.
Yeah, the combination is what they're looking for. They want that potential for an explosive move driven by a short squeeze.
And how do they usually play this? You mentioned options traders.
Often, yes. Call options are a popular vehicle. Buying call options gives you the right to buy the stock at a set price later. It offers leverage. A relatively small move up in the stock price can lead to a much larger percentage gain on the option.
So more bang for your buck if the squeeze happens, but also defined risk if it doesn't.
Generally, yes. Options allow them to position for that potential upside volatility without necessarily tying up the capital needed to buy the shares outright.
Yeah.
It fits that specific catalyst-driven trade profile.
Makes sense. And what about risk management for anyone deciding to short a stock that already has high short interest? Even the pros must be careful there.
Absolutely paramount. If a professional decides to initiate a short position in a stock that's already heavily shorted, they'll almost always do it differently. They might take a much smaller position size than usual, or they might use options to define their risk, perhaps buying puts instead of shorting stock directly, or they might employ other hedging strategies alongside the short.
Because the baseline risk is just inherently higher.
Exponentially higher. The odds of getting squeezed are significantly elevated, so they adjust their strategy accordingly. It's always about managing that risk-reward trade-off.
Okay, this is great. We've got the concepts, the why, the how. Let's get into the real nitty-gritty now. What specific numbers or thresholds do pros really zero in on? You mentioned keeping it simple, so what are the key benchmarks?
Definitely. The most watched metric is probably short interest as a percentage float. And while there's no magic number, there are generally accepted thresholds.
Yeah.
Most pros would consider anything above, say, 20% of the float being short as high. That's kind of the first level where you start paying closer attention.
Then 20%.
If it gets up above 30%, or especially 40%, that's usually considered extremely high. That's territory where the potential for a short squeeze becomes a really significant factor in the stock's dynamics. Those are the levels that really stand out.
So 20% is notable, 30–40% is getting into the red zone, potentially. Good benchmarks to keep in mind.
Exactly. Gives you a simple framework. Then there's the days to cover, DTC, we talked about.
Right, the bottleneck metric. How do they look at that number? Is higher always more dangerous for shorts?
Generally, yes. A higher DTC ratio, maybe anything over, say, 5–10 days, though it varies by stock liquidity, indicates that shorts could get trapped more easily. It signals that there isn't enough average daily volume for all the shorts to exit their positions smoothly or quickly if they need to. A high DTC makes a squeeze more potent if it starts.
Because they can't all run for the exit at the same time without tripping over each other and pushing the price way up.
You got it. It highlights that exit risk for the shorts.
But what about that third one, the cost to borrow? You mentioned fees for borrowing shares. How does that play in?
Yes, the cost to borrow. This can be a really telling indicator, sometimes overlooked. When you short, you borrow shares, and you pay interest on that loan. If the cost to borrow those shares becomes very high, it tells you two things. One, there's very high demand to short this stock. Two, the existing shorts are paying a lot just to maintain their negative bet.
So it puts financial pressure on them even if the stock price isn't moving much.
Exactly. High borrowing costs eat away at potential profits and increase the pain of holding the short position. It can force shorts to cover simply because it's becoming too expensive to stay short, adding another potential catalyst for upward price movement. It's like a slow bleed for the shorts.
Interesting. So it adds another layer of pressure. Okay, so pulling all this together, what's the big takeaway for our listeners? We've covered a lot of ground.
I think the main takeaway is that short interest isn't just some obscure number. It's a really valuable piece of the market puzzle. It tells you the percentage of shares betting against a stock.
Right, and we've seen how the pros use it not just as a simple bearish signal, but to gauge sentiment, manage their own risk, and sometimes even spot those potential squeeze opportunities.
Exactly. It helps you turn what feels like information overload into hopefully clearer insights. Understanding this helps you keep the analysis simpler, focusing on a key dynamic.
So really, grasping this gives you a much deeper view of what might be driving a stock's behavior, beyond just the headlines. It's a lens to see potential underlying pressures.
Absolutely. Which leads to maybe a final thought, something for you to consider.
Okay.
Next time you see a stock making a really big, maybe unexpected move up or down, but especially up when it seems illogical, just pause and ask yourself, could high short interest be playing a role here? Was there a hidden pressure cooker building up that finally blew?
How might this seemingly simple metric, the percentage of shares short, actually reveal forces at work that most people aren't seeing?
Yeah. It encourages you to look beyond the surface. It's often those hidden dynamics like extreme short interest that explain the moves that leave many scratching their heads. Understanding gives you that extra layer of insight.